Hi, welcome to Let's Talk Bonds, the fortnightly podcast from INR Bonds. I'm Arjun Patsati. And in this podcast, we're going to talk about the high yield market in India, which is going through a very strong growth phase. And this has come about largely due to many factors, which I'll take you through. But just before that, if you're a financial advisor, the best place for you is INR Bonds Partner. You can see the best bonds, most information, and make the right investment decisions for your clients, whether it's high yield or regular bonds. And you have to, all you need to do is just log into INR Bonds and sign up as partner and see your fixed income assets. So, and our app, Quick Invest by INR Bonds, the best gives you the best curate list of bonds with transparency in prices, all the information that an investor requires to need it to take a decision on the kind of bonds that they need to invest in, and along with the most seamless in-app investment process. Download the app now, iOS and Android. And if you're not subscribed to our YouTube channel, please do so, and do press the like button if you are happy with the podcast, and happy to get your comments. Coming back to the high yield market in India. So I would classify the high yield market as anything that ranges from 9% to even 20%. So let me go from the highest yield down to the lowest yield. So there's a huge market that is beginning to happen in the 15 to 20% kind of yield range. But this is very largely private credits. And the private credit market is driven by launch of AIFs that is investing in such high yield credits. And there is a lot of investor interest in these AIFs offering 15 to 20%. Most of these bonds are unlisted, but like I said, it's private credit, not highly publicly traded, but at the same time offering a very high yield to investors. This market is growing very fast, and there are many AIFs that is getting launched. And given that the economy is now seeing a good amount of traction, there are a lot of companies that are offering such high yields as they are seeing growth. And most of these companies that are actually raising money at such high yields are normally unlisted companies, and or they have, it could be promoter funding, like the recent one of Shapoorji Pallonji, the Goswami infrastructure that was backed by Tata Sons, pledge of Tata Sons shares, which was closer to 18%. And many as such, there are many other companies that are into different areas, very largely many real estate companies. Real estate too is seeing some kind of improvement there across the country, and that is leading to more developers and more investors looking to lend to these developers at much higher yield than what is available from the banks. And largely because they're taking such high yields because of the fact that the banks and traditional lenders are not willing to are not able to assess the kind of risk. Hence, the intermediation of credit has gone to the AIFs and fund. And given that they are all AIF structures and minimum investment is 1 crore for AIF, then what really then investors are more comfortable taking the risk, because normally anybody who invests 1 crore or above in an AIF would have a much higher net worth and the ability to take any kind of losses if it occurs in any form. Then coming down to below the 15% market, you have lenders that are coming in to raise funds, and many of these lenders are in the high are in the retail lending space or microfinance space. The margins are pretty good. Many of them, the personal loans or microfinance loans or SME, MSME loans, all of them are taking place in the range of around 20% to 30%, 25% to 30%. And hence, when they come to raise funds in the market, given the unsecured nature of loans and the riskiness of nature of loans, these bonds, these companies raise funds anywhere between 10 to 15%. Now, again, going to the private credit space, the ratings of most of these companies are in the triple B, which is just at investment grade. And while the 10 to 15%, 10 to 15% range, they are in the range of A minus to even double A. Some credits, though the rating is higher, are still trading at the 12-13% levels, largely because of some issues that are facing the particular issuer. Now, particular case in point is India Bulls, that is trading at much higher levels. Many perpetual bonds of banks, lower rated banks, are trading at such kind 12-13% kind of levels. Hence, but having said that, there are other companies, microfinance companies like Swatantra Microfinance, you have Belstar, you have Ashirvad, you have Annapurna Microfinance, Spandana Spurti, and many others. All of them trade in a range of 10 to 15% kind of, 10 to 13, 14% kind of levels. Not so much 15%. So anything over 13% again goes into a realm of a different kind of credit. And anything 14 to 15%, I would 13 to 15% yield range, 13.5 to 15% or yield range. I would suspect they would be in a triple B kind of a category. But we haven't seen too much of trading in that particular one. So let's put the traded listed market for higher yield lenders in the 10 to 13 or 13.5% range are in the rating of A minus to double A, right? Maximum of double A. And then you have even double A, even A rated companies are doing very well. One case in point is Credit Grameen, a microfinance lender, which has seen its equity price traded at record highs and showing very strong business traction. So that is being traded at levels of 9 to 9.5% for 1 to 2 year kind of bonds, and 1.5 to 2.5 years kind of bonds, you could say that. And hence market a company, an issuer like Five Star Business is around 9% levels, 9 to 9.2% levels. Then you have other issuers, some of them state guaranteed bonds like UP Power and AP State Beverages. They are in a range of 9 to 10% kind of levels. Hence, many of these issuers are trading at such levels. The other bonds that are traded in this such kind of levels would be Shriram Finance, maybe 3.5, Ashok Leyland Finance, and Hinduja Leyland Finance, and other some of the other such bonds. They are traded at such levels, Avance Finance. And then, so these I would classify as the high yield market. And this 9% to 12%, 13% market is again fed by retail interest, individuals, high net worth, or even ultra high net worth investors clearly wanting higher yields, because one is clearly inflation is not coming down in the economy, even though headline inflation is down. Second is RBI is keeping the rates high. They might hike one more rate in the next this week, coming policy week after the Fed rate hike. Globally, rates are also high. And also the fact that many of the investors are becoming more comfortable with the credit because the economy is really doing well. We are seeing very strong numbers, equity markets are at record highs. Companies are coming out with very strong results. And so hence, when companies are coming out with very strong results, balance sheets become stronger. And even for they are able to raise debt and also raise equity at better valuations, hence keep their capital adequacy lower and also enable growth in their business. So all this put together is leading to investors having getting more comfort and on such bonds. And also there are many PMSs that are being launched and a few AIFs too, which are offering returns of around 9 to 12%. So all this put together is helping the high yield market grow. And this is going to continue for a while, the way it's going. There's a lot of interest in by investor segment in such markets, in such bonds. And clearly it will be demarcated. But you could also see that some of the bonds in the 15 to 20% category, they could be packaged, listed, and then sold down to retail investors. Then there could be portfolios offered for individual investors with 9 to 13% kind of range and all that. So hence put together, everything is definitely looking very strong for the retail, for the high yield market in India, largely driven by retail investors. And but however, the risks are there, obviously. If more and more money goes into such, there could be many AIFs that are not concentrating on their credit, not doing enough due diligence because they collect money and the pressure to invest is high. And also because of if there's too much money chasing too few issuers, there could also be a fall in demand for such, fall in rates, and the risk may not be commensurate with the return. But and there could be dilution of risk. So all put together, there is obviously risk. Investors and financial advisors must be cognizant of such risks. Thank you very much for listening in, and do follow us on all podcast channels. And happy to hear about your comments.